Traditional 401k. The traditional 401k is the most common retirement account in America, and it works on a pretty straightforward deal with the IRS. You put money in before taxes touch it, straight from your paycheck. Say you make $60,000 and contribute $6,000, you only pay taxes on $54,000 that year. That money grows tax-free for decades while it sits in the account, compounding away. The catch comes later. When you retire and start pulling money out, the IRS treats every dollar like regular income and taxes it at whatever rate you're in then. Most people assume they'll be in a lower bracket when they're older and not working, which is why this setup usually makes sense. Roth 401k. The Roth 401k flips the traditional model on its head. You fund it with money that's already been taxed, so you don't get any immediate deduction on your tax return. That stings a bit in the short term because your paycheck takes the full hit. But here's the payoff. When you retire and start pulling money out, those withdrawals are completely tax-free, assuming you've followed the rules. That means all the growth your investments made over the decades comes out without the IRS taking a cut. This one makes the most sense if you expect to be in a higher tax bracket later, or if tax rates in general go up. You're basically paying tax at today's rate to avoid paying it at tomorrow's rate. Traditional IRA. A traditional IRA is a retirement account you open yourself, separate from any employer plan. Anyone earning money from work can set one up at a bank or brokerage. The main appeal is that your contributions might reduce your taxable income for the year, though whether you get this deduction depends on how much you earn and whether your job offers its own retirement plan. The money grows tax-free while it sits in the account. When you eventually withdraw funds in retirement, that's when you pay income tax on it. Think of it as a deal with the government where you defer taxes now in exchange for paying them later. You can contribute up to a set limit each year that adjusts for inflation. Roth IRA. The Roth IRA flips the traditional model on its head. You put in money you've already paid taxes on, which sounds like a raw deal at first, but here's the catch. Everything that money earns afterward is yours tax-free forever. When you retire and start pulling it out, the government doesn't touch a dime of it. There's no required minimum distribution either, so you can leave it alone as long as you want or pass it to your kids. The trade-off is income limits. If you make too much, you can't contribute directly, though there are workarounds people use. For younger earners or anyone expecting higher taxes later, this one's basically unbeatable. SEPIRA. A SEPIRA is basically an employer-funded retirement account designed for people who work for themselves or run tiny businesses. The setup is dead simple compared to most retirement plans, which is the whole point. Here's how it works. Only the employer puts money in, meaning if you're self-employed, you're contributing as your own boss. The contribution limit is way higher than a regular IRA, currently letting you sock away up to 25% of your compensation, maxing out at over $60,000 depending on the year. There's no annual filing requirement like you'd have with a 401k, which saves you paperwork and accounting fees. Every eligible employee has to get the same percentage contribution, so if you have staff, whatever you put in for yourself percentage-wise, they get too. Simple IRA. The Simple IRA was designed specifically for small businesses with 100 employees or fewer. It stands for Savings Incentive Match Plan for Employees, which pretty much tells you what it does. Employees can put away money from their paychecks, and here's the twist. Employers have to chip in too. They can't just offer this plan and walk away. The employer has two options for their contribution. They can match what employees put in dollar for dollar, up to 3% of their salary, or they can just give everyone 2% whether they contribute or not. That mandatory contribution is what separates this one from a standard 401k, where employer matches are optional. Solo 401k. The Solo 401k was created specifically for self-employed people who don't have any employees, except maybe a spouse. Here's what makes it powerful. You get to contribute from both sides of the equation. As the employee, you can put in up to the standard 401k limit, which is $23,000 if you're under 50. Then as the employer, you can contribute up to 25% of your compensation on top of that. Combined, you can potentially sock away over $60,000 a year or more if you're older. That's significantly higher than what you could contribute to an IRA. The catch is, you really can't have employees. Hire someone full-time and you'll need to switch to a different plan structure. But if you're a freelancer, consultant, or small business owner working solo, this one lets you turbocharge retirement savings. 403b. A 403b is basically the non-profit world's version of a 401k. If you work for a public school, a hospital, a church, or pretty much any tax-exempt organization, this is what you get instead of the regular retirement plan. The mechanics are almost identical. You put money in before taxes hit it, it grows without getting taxed along the way, and you pay taxes when you take it out in retirement. The contribution limits match a 401k dollar for dollar. The main difference is that 403b plans sometimes have fewer investment choices. Many of them lean heavily on annuities or a smaller menu of mutual funds, whereas 401k plans often give you more variety. Some 403b plans also have lower fees, though that varies wildly depending on who's running yours. 457b. The 457b is the oddball retirement plan that government workers and some non-profit employees get access to, and it has one feature that makes it genuinely different from everything else. Like a 401k, you put in pre-tax money up to an annual limit, and it grows tax-deferred until you withdraw it. The weird part is what happens when you leave your job. With most retirement accounts, if you pull money out before you hit 59.5, you get slapped with a 10% early withdrawal penalty on top of regular income tax. The 457b skips that penalty entirely as long as you've actually separated from your employer. You still pay income tax on whatever you take out, but that extra 10% hit just doesn't exist here. Thrift Savings Plan. The Thrift Savings Plan is what federal employees and military members get instead of a standard 401k, and it's honestly one of the better deals in retirement savings. The fees are ridiculously low, usually around 0.04%, which means more of your money actually stays yours and grows over time. You can choose between traditional contributions, where you defer taxes until retirement, or Roth contributions, where you pay taxes now but withdraw tax-free later. The real advantage is the matching. If you're a federal employee under FERS, the government automatically puts in 1% of your salary, even if you contribute nothing, then matches dollar for dollar up to 3% and 50 cents on the dollar for the next 2%. Military members as of 2018 get similar matching under the blended retirement system. Pension plans. A pension plan is when your employer promises you a specific monthly payment for the rest of your life after you retire. The amount you get is based on a formula that looks at your salary and how many years you worked there. Say you worked for 30 years and your average salary was $60,000, the company might pay you $2,000 a month starting when you turn 65 every month until you die. The company is on the hook for that money, which is why most private companies stopped offering these decades ago. They're expensive and unpredictable since nobody knows how long you'll live. Government jobs still have them though, which is one reason people say government benefits are better. You don't control the money or invest it yourself. You just show up, work your years, and collect the checks later. Backdoor Roth. This one is basically a workaround for people who make too much money to contribute directly to a Roth IRA. The IRS sets income limits on Roth contributions, but here's the thing. There are no income limits on converting a traditional IRA to a Roth. So you make a non-deductible contribution to a traditional IRA, which anyone can do regardless of income, then immediately convert that money to a Roth IRA. You pay taxes on the conversion, but since you didn't deduct the original contribution, there's usually nothing to tax. The money ends up in your Roth where it grows tax-free forever. Congress closed a bunch of tax loopholes over the years, but left this one wide open, probably because it actually generates tax revenue when people convert.